So you want to start trading options. Let's get into what options are, how they work, and how to trade them on the Robinhood platform. So options are the agreement between two people that the buyer has the right to buy, but not the obligation to buy or sell 100 shares of underlying stock at a predetermined price. This predetermined price is called the strike price. If you buy a call option, you have the right to buy 100 shares at that strike price. If you buy a put option, you have the right to sell 100 shares at that strike price. So let's get into Robinhood's app. Now that we're here on the Robinhood page, we can see that my account is on screen. We have options. Normally options are on the top part of your current positions tracker. Stocks are after that, and then cryptocurrencies are after that. And then you can have your stock tracking list after that as well. If you want to turn on options in your account, you just want to go to Account, Settings, Options Trading. Ooh, there we go. Options Trading. And then you should see a button that says Turn on Options Trading or something to that effect. And you should be able to turn on Level 2 options. This is the basic options level and only leaves out option spreads, which is a more advanced topic that I'll be talking about in the future. But right now you should be perfectly fine with Level 2 option strategies that are offered. Usually these are the buys and the sells of call options and put options. So let's get back to the home screen and pick a stock to trade a option on. So I prefer to trade options on TNA personally. TNA is a small cap ETF that follows the S&P 500, and it has some great markers that I like because it does follow the market. So here is the options chain that Robinhood provides us. We can see that on the left-hand side, we have the strike price, which is that predetermined price that I mentioned earlier. We have a break-even price. So if I bought this call option, so like let's talk about the $99 call option here. If I were to buy this $3.48 per share option, so $3.48 per underlying share, so I'd be spending $348 on this on one option contract. Then I need to look at the break-even price. So I won't make a single cent until the share price or the underlying share price reaches above that threshold. So I won't make money until the underlying share is at $103.49 if I were to buy this option. So let's go ahead and look at some information that Robinhood provides in the options chain itself. So you have the bids and you have the ask. Usually the bids are the people that are trying to buy at a certain price, and the ask are the people that are trying to sell at a certain price. The mark is usually the dead center between those two numbers, depending on how much the spread is there. And the spread is the difference between the bid and the ask. You can see information like the previous close, the current high for the day, the current low for the day, how many options have traded for this, what's the open interest and implied volatility by buying this option. So something that the mobile app shows that the current desktop doesn't is the percentage of the probability of profit. So sometimes you'll see a probability of profit that will tell you how likely you are to make a profit if you buy that option. So one thing I want to talk about is currently the $99 call option that we're looking at is out of the money. And what out of the money is for a call is anything above the current share price. Anything in the money or considered in the money is anything below the current share price for calls. Usually in the money is what would be executed at expiration. And I'll talk about that in a few minutes. As far as a put, Anything above the current share price is considered in the money, and anything below the current share price is considered out of the money. Because at expiration, those shares would be executed. Now, what does execution mean? So this means that at expiration for your stock or for your option, it would be executed if there is some kind of profit margin on the option that you own. So let's say I bought this $99 call option that I was talking about earlier, and the share price, underlying share price, went to $99.01. On the day of expiration, so Friday at 4 p.m., Robinhood would go ahead and exercise my option for me and make sure that I get that profit. It's a cent per share, so it's $1 overall, but it's at least something, and they are going to protect me as their client to make sure that my option is executed in the money and I can retain as much value as I possibly can for owning that option. Now, if I bought, or if it stays at 98 cents and $98.89, and I had this $99 call option, that call option would expire completely worthless. Another thing to note about expiration is if you do exercise a stock or an option that's in the money, you need to make sure that you have the underlying collateral for that option. So, or if you hold it till that point. So if I was able to hold, or if I held my call option for $99 for my TNA stock that we've been talking about, I would need to have $9,900 in my account for that option to be exercised. Now, don't worry, Robinhood is awesome with this. They will exercise your stock option and then immediately sell it, so you can retain the profit of the difference between what you bought at and what they sold it at, which is usually the trading price at close of that day. Look at some other pieces of information that I kind of want to touch on before we transact on this $99 call option that we've been talking about all day. So one thing I want to mention is delta. Delta is kind of a value, if all things stay consistent, about how much my one underlying share value of this option is going to rise. So for every dollar that underlying share price rises. So if the TNA rises to $99.89, we should see a 60-cent increase per underlying share of the option. So we should see this go to about $3.98. So overall, our option value will go from $348 to about $398. Theoretically, if all things stay consistent. Another thing that I want to mention is Theta, which Theta is time decay, or decay over time. And we can see on this option that we'll be losing about 65 cents per underlying share, so $65 per day of time decay of the option. Because as we get closer to expiration date, the options, the volatility or the time that the underlying shares have to move is limited, so options become less valuable. And that's represented in Theta. Just a few things that you should keep in mind, and I wish I'd learned that when I was starting in your shoes, trading my first option. So let's go ahead and transact on this one option. So Robinhood likes to stage our purchase order. We're going to do a long call, so purchase a call with an expiration date of 2/12, which is Friday, February 12th of 2021. And then we're going to press continue. It's going to ask us how many contracts we want, and each one of those contracts is 100 underlying shares each. So let's say we bought one. And then our limit price, which Robinhood is so gracious to go ahead and put that mark price in there for us, but I don't want to spend more than $3.30 per underlying share for this option, and I want this option or this order to expire if it's not filled by the end of day today, which would be 4 p.m. Hit review order. It's going to do one last check. It's going to tell us exactly what we're doing. It's going to give us a summary of that, and then we can hit submit, which for me, it's going to ask me for my login credentials, and after I hit submit, I'm going to have to put that stuff in, and it would allow us to send this contract through, and we own the contract once the order gets placed. So let me know what you learned today, or if you have any more questions revolving around trading options. This was just a quick and explanation of how to buy a call. Buying a put, it's the exact same way. You can sell a put and you can sell a call the exact same way as well. Hope this helped you. See you next time.